I might put $500,000 into this stock, and today I'm going to walk you through exactly why. This is not hype, this is not a gamble, and this is definitely not one of those get-rich-quick fantasies. This is a detailed breakdown of a company that is quietly positioning itself for explosive long-term growth, while still being undervalued compared to its true potential. And if you stay with me until the end, I'll show you the exact price targets, risk factors, and the strategy I would personally use if I were allocating this much capital. Before I even consider putting $500,000 into anything, I go through a long checklist. Market advantage, revenue growth, long-term moat, management credibility, debt levels, risk-reward balance, and future catalysts. This stock checked more boxes than almost anything I've analyzed in the last 12 months. The more I researched, the more I realized this company is sitting in front of a megatrend that is still in the early innings. And whenever you find a great company positioned ahead of a megatrend, that's where generational wealth is created. So let's talk about the big reason I'm interested: secular growth. No matter what the economy looks like, no matter what inflation is doing, no matter what elections change or don't change, this company is tied to a long, unstoppable shift that will turn into trillions of dollars in the coming decade. And that shift is artificial intelligence infrastructure. Everyone talks about AI software. But the real money is flowing into the picks and shovels, companies building the physical backbone that makes AI possible. And while one company, NVIDIA, has taken most of the spotlight, there are emerging players in niche parts of the infrastructure market that are catching up faster than people expect. This stock is one of those players. It operates in a field that is about to explode: AI data management and enterprise automation. And while tech giants are racing to build bigger, faster AI models, this company is building the systems that allow businesses to actually use AI at scale. That's the key difference. AI is useless if companies can't integrate it into real operations. And this company solves that problem better than almost anyone. When I analyze a high-growth company, I always start with revenue trends. This stock grew its revenue more than analysts expected for multiple consecutive quarters, and not just by a little, by double-digit percentages. But what impressed me more was the shift from unprofitable to increasingly profitable operations. They're tightening expenses, raising margins, and converting more of every dollar into actual profit. That's what long-term investors want to see. It shows discipline. It shows management is serious. And it shows that growth is sustainable. Speaking of management, I always research leadership. In this case, the CEO and executive team have a track record of building successful companies in the past. They're not new to this game. They understand how to scale technology businesses and how to transition from niche startups to enterprise-level operations. And investors often underestimate how much management matters. A great company with terrible leadership almost always collapses. But a good company with excellent leadership often becomes a great one. Now, let's talk about something that really caught my eye: the partnerships. This company is quietly partnering with major enterprises and public sector organizations that many people don't know about because they aren't flashy headlines. These partnerships create long-term recurring revenue, which is the holy grail in business. When a company is generating predictable monthly and yearly revenue from contracts, volatility doesn't hurt them as much. Even in a recession, those clients remain. And with each new customer added to their platform, the network effect gets stronger. But the biggest catalyst is this: artificial intelligence adoption across businesses is still less than 20%. That means over 80% of the market hasn't even begun the transformation. Global Fortune 1000 companies are rushing to implement AI workflows, automate processes, and analyze large volumes of unstructured data. And this stock is one of the few players that specializes in that exact niche. Every year, companies will be forced to lean on AI just to stay competitive. And this company will be one of the primary beneficiaries. Now let's talk about valuation. This stock is not cheap, but that's not the point. A great company rarely trades like a bargain. The point is whether it's undervalued relative to future growth. And based on current projections, Wall Street is severely underestimating its revenue potential over the next 3 to 5 years. Analysts tend to look quarter to quarter. But investors who think long-term understand that this company could realistically double or even triple its revenue once AI adoption hits mass scale. And here's the key question you're probably thinking: why consider investing $500,000? The short answer is conviction. When I reach a point where a company has the competitive moat, the growth runway, the leadership, the financial discipline, and the market positioning to become a multi-billion-dollar winner, that's when I go in big. Not recklessly, but strategically. Let me break down what my strategy would be if I were allocating that amount of capital. First, I would never put the full amount in at once. I would dollar cost average over multiple months. AI stocks are volatile. They run up fast, they pull back fast, and you want to take advantage of those dips. Second, I would split the investment into 3 phases. 30% immediately because long-term conviction matters. 40% on major pullbacks of 10% or more. And the remaining 30% only if the company hits specific progress checkpoints, revenue targets, new partnerships, or profitability milestones. This way, I'm not just betting on hope. I'm betting on measurable progress. And that's how you survive long-term in the stock market. Discipline, not emotion. Now let's talk about the risks. Because no investment this large should ever be made without understanding what could go wrong. The first risk is competition. Big players like Microsoft, Amazon, and Google have enough money to build similar systems. But here's the catch. Large companies move slowly. They innovate, but they don't innovate fast. And this stock is moving quickly, forming partnerships, adapting to enterprise needs, and building solutions that integrate easily into existing systems. That agility is a massive advantage. Second risk. Valuation volatility. High-growth companies can swing 20 to 30% in short periods. But that's normal. Long-term investors don't panic over volatility. They use it to their advantage. If the company continues to execute, short-term dips become buying opportunities. Third risk. Execution. The company must continue delivering strong revenue growth and improving margins. If they slip, Wall Street will punish them. But based on the last few quarters, execution has been strong. Now let's talk about what I believe is the most exciting part of the entire story, the future potential. When AI becomes deeply integrated into everyday business operations, finance, healthcare, manufacturing, defense, logistics, this company's solutions become essential infrastructure. And essential infrastructure companies are the ones that grow steadily for a decade or more. Think of cloud companies 10 years ago. Think of cybersecurity companies 5 years ago. Think of semiconductor companies before the AI boom. They all had one thing in common. They became unavoidable. This stock is on that same path. It's early enough to offer massive upside but established enough to have real revenue, real clients, and real technology. That balance is rare. Most early-stage companies have growth but no stability. Mature companies have stability but limited upside. This stock has both. And when you combine this with the fact that institutions are slowly increasing positions, it becomes even more compelling. Smart money always moves early. Retail investors usually show up after the big gains are already gone. But right now, institutions are quietly accumulating shares, slowly increasing their exposure every quarter. That's a signal I never ignore. Let me answer the question you're probably asking. How high can this stock go? While I never give specific financial advice, I can tell you based on revenue trajectories, market positioning, and AI infrastructure projections, this stock could realistically 3x to 5x over a multi-year period if it continues executing. Not in months, but in years. That's the difference between speculation and long-term investing. It's about patience. If I were putting $500,000 into this stock, it would be for one reason: long-term conviction in a company that is part of one of the biggest shifts of our lifetime. AI is not a trend. It's the next industrial revolution. And companies powering the infrastructure of that revolution will create wealth on a scale most people can't imagine yet. In closing, always do your own research. Never invest money you can't afford to lose. But when you find a company that is early, essential, and executing with precision, that's when opportunities appear. And this stock, in my opinion, is one of those rare opportunities. If the execution continues and the AI transformation accelerates as expected, this stock could become one of the most important players in enterprise technology. This is why I might put $500,000 into it. Not because of hype, not because of speculation, but because the data, the trend, and the fundamentals all align toward long-term growth. And as always, the goal is simple: invest smart, stay patient, and let time do the heavy lifting.